Welcome back to the Wall Street Podcast. Today, we're taking a deep dive into China's industrial technology sector. It's a landscape seeing some, well, significant rebalancing.
Yes, we're looking closely at the China Industrial Tech 2H25 outlook. Defensive plus AI, as barbell approach to counter-softening FA report. This was published by Goldman Sachs Asia LLC just yesterday, August 6, 2025. It really digs into the factory automation market, company growth drivers, and strategic investment ideas.
Right. And our goal here is to pull out the most critical insights for you, focusing on where industrial automation demand is heading and, how the key companies are reacting.
Exactly. The report hits on the FA industry outlook, those vital company-specific factors for growth, and then investment preferences. And they're clearly favoring defensive stocks, plus those tied to AI and humanoid robotics. While being cautious on others.
Okay, let's unpack that first part. What is Goldman Sachs' core view on the market outlook for China's industrial automation, and what's driving this fairly cautious forecast?
Well, the main outlook is for a prolonged but modest down cycle. They're forecasting small annual declines, actually, about -1% year over year in 2025, then maybe -3% in 2026, and -2% in 2027.
So not a sharp drop, but a sustained softness.
Precisely. It's mainly because current utilization rates and production volumes, they don't really support big increases in capital spending across most manufacturing. Interestingly, they note the anti-involution campaign doesn't seem to be a major drag, or a boost for that matter.
Huh. And mitigation factors.
Yeah, the main buffer seems to be government policy support for industrial equipment upgrades. That helps limit the downside risk.
Right. That makes sense. So in this kind of challenging, slow-growth market, what are the critical strategies for companies looking to grow, and which specific tech segments offer the best upside potential?
In this environment, it really boils down to company-specific factors. Internal drivers are key. Things like gaining local market share, pushing into overseas markets.
Oh.
And also, product premiumization, focusing on higher margin software, maybe advanced sensors. Now, future industries like AI and robotics, they definitely offer potential upside. Big potential. But the report cautions that the technology barriers are high, which could complicate commercialization.
So not an easy win there.
Not necessarily quick, no. An actual CapEx expansion. It's expected mainly in very specific niches. Think foldable phones and consumer electronics, solid-state batteries, and ADC, that's AI-driven data centers.
Got it. That brings us to the investment strategy. How should investors approach this? Which specific companies are getting highlighted, especially those using AI or defensive angles, and why them?
Goldman Sachs suggests a barbell strategy. Basically, balance defensive stability with these high-growth AI-type opportunities.
Okay, the barbell. Makes sense.
So on the defensive side, they like NARI Tech. That's due to smart grid investments and benefiting from AI's growing power demands. There's also AVC Johnson, strong in aerospace and defense, plus a growing business in liquid cooling. And CRRC, noted for an attractive dividend yield and its stable railway business.
Stable and yielding. Okay, and the other side of the barbell, the growth plays.
Right. The tactical positives, they point to Sanhor, particularly for humanoid robot actuators. They leverage existing expertise from HVAC and EV components. Also Luster for optical motion capture tech, which is apparently crucial for training humanoid robots.
Interesting tech.
And then in the data center space, K-Star is favored for strong order intake, helped by chip supply easing up a bit. And VCool as well, for opportunities in liquid cooling, also tied to data centers and AI infrastructure.
So those are the preferred names. Any areas they suggest caution?
Yes. They issued downgrades for some traditional factory automation players, specifically Eston and Rakis. The rationale is that their main businesses are vulnerable to the slowdown, and maybe the market's a bit too optimistic about their newer ventures, which are still early stage.
Understood. So wrapping this up, what does this mean for the general public, for you listening? It sounds like less about a broad industrial downturn and more a rebalancing, right?
I think that's a good way to put it. The modest decline in overall factory automation suggests maybe fewer massive new factory projects. But the targeted growth, especially in AI, robotics, you see it with companies like Sanwa and Luster, that can actually speed up development of advanced devices, things closer to our daily lives.
So maybe smarter devices, more automated services.
Could be. Well, overall manufacturing growth stabilizes the innovations in, say, smart grids via NARI Tech, or the advances in humanoid robots and AI data centers from K-Star and VCool. These could lead to more intelligent infrastructure, maybe even transformative tech, impacting daily life down the road. Think advanced electronics, more efficient utilities. It's a shift towards, perhaps, smarter integration rather than just sheer volume.
A complex landscape indeed, but as the report shows, there are clear strategic pathways emerging.
Absolutely. It requires careful attention. Thank you for joining us for this deep dive into the latest industrial tech outlook.